So we are at the top of the hour now, 4 o'clock. I appreciate those who chimed in today to listen to this, not really a presentation, but more of a question and answer session between myself and a good friend of mine, Jeremy Burch, who is a CPA here in Athens, Georgia, where we're located. And Jeremy, anything you want to introduce yourself differently than what I already said?
I think you've covered it. Yeah, just
That
Jeremy
was very
Burch,
short and sweet, Jeremy.
CPA here with Smith Adcock and Company. We have offices in Sandy Springs and then here in Athens. And yeah, known Chris a couple years now. Love working with him.
Yeah, Jeremy's a good guy, does great work, him and his firm. So I thought what we do today, since Jeremy, we are through tax
Mhm.
filing season on the personal level, except for exemptions, that since that's kind of behind some people at this point. Usually May, June, July is, I spend a lot of time in my practice and my other consultants in the practice spend a good bit of time talking to our clients about things that may, looking back in the prior year, 24 now, some things maybe they ought to consider doing, not necessarily differently, but tweaking a little bit, definitely having conversations with their CPAs. And I think, yeah, of course, your firm and you all reach out and do that with clients also, but just some strategies maybe out there we ought to be considering. So, Jeremy, I thought it'd just be a good idea for me to kind of pepper you with a few questions. This is one of the easier presentations I've done this year because I don't have to do much but ask questions. My prep work was easy. Is there anything else you want to comment on that as we go forward as far as strategizing with clients?
No, just to reiterate what you said, this is the perfect time of year to be evaluating those things. If you have completed your 2024 returns, you've seen the results, good or bad, and it's the only way we can change those is to plan and try and be proactive and make proactive changes.
All right. I mean, there are some ways we can do some things. And I think people miss that sometimes. They file their return. Sometimes they do it on their own. They don't have a CPA do it, obviously, but they file the return and just kind of go about their day, except they're paying taxes on what they pay taxes on. But there are some things they can do to save a little money, possibly. How about that for an answer?
I like it.
We don't know, do we know? Okay. So at least ask the question. So here's how we're going to get started. So we've got a list of questions, folks. I'll put those up on the screen so you can see them in case you chime in and out. And sometimes I talk fast. So I want you to see what we're going to ask. So first question for you, Mr. Birch, is the most famous question you and I get asked all the time. How do we reduce our tax? Well, let me change that. How do we pay less in taxes, right? So, I mean,
There you
nobody
go.
wants to earn less money. They just want to pay less in taxes. So how can we do that maybe going forward?
And you stole my punchline. My
Ah,
punchline was
dang
going to
it.
be you make less money.
Yeah, I tell clients that all the time. You want to pay less tax, make less money. So
I try and convince my clients every year that having an income tax problem is a really good problem to have. It means you've done something right.
do they actually believe you when you tell them
I like to think so.
that?
So, the approach I take here is generally this is more about optimizing your current situation. Is everything structured on your personal tax return in such a way that we are taking advantage of everything we can take advantage of? And, maybe that means analyzing the structure of a business you're involved in or the timing of money coming in, whether it be from sale of stocks and securities, which Chris is the expert on, or, grouping and bunching charitable contributions. There's lots of things. But this is a hard question to answer generally. Other than you've got to be working with people that know what they're doing. Yeah, you need to have a qualified financial advisor. If your situation is complex enough, you need to be working with a CPA to try and make sure you are taking advantage of everything that is available to you to reduce your taxable income.
Okay. Well, I appreciate that plug on the advisor planner side. So that's great. Let me ask you a couple of just for this one, just a couple of things that maybe people do or don't do, just to throw
Hmm.
out there, maybe some comments on that. So obviously, most of us who work, right, in some business, small business or corporation, we have company retirement plans. So
Hmm.
obviously being able to defer in your company retirement plan, that's a lot of my first step conversations with clients is let's put more on the shelf and you'll pay less tax on it this year.
Absolutely. And that's low hanging fruit.
Right.
If you're a W-2 employee and your employer sponsors a plan, or if you're self-employed and you want to set up a solo 401k, that's a great way to pretty quickly reduce your taxable income And it's a lot more attractive than just buying deductions as a business owner because the money's not going away. You're just squirreling it away for retirement.
Sure. And so IRAs are an easy one. I think pretty
Mhm.
much most people know there's an IRA out there. Potentially, of course, with whether they can participate in an IRA or not based on their income level. HSA is another one. HSAs are some that people, when I talk to clients, they tend to forget about a little bit. Any comments on HSA?
They are a great tool, and the money just doesn't just go away if you don't use it for health insurance. But if you're in a high deductible plan, maxing out your HSA every year if you're able to is another excellent low hanging fruit way to reduce your taxable income. And again, it's just a savings account for the what if scenarios, so the money isn't really going away.
Right. As planners, we love them because what I like to see with my retirees when they get to that point, I love them to have a bucket full of HSA type money, health savings account money they can use for what's not covered under Medicare or any of the supplementals that they have out there. And typically they wind up using them over their lifetime in retirement years. So I love them, and we talk in the October, November timeframe with employees who are deciding on what options to pick and their benefits at work. I mean, we do discuss high deductible. If they have a high deductible health benefit or plan out there, that may be part of the conversation to participate in HSAs too. Particularly their employer will also match that, which we may see also. Okay.
Absolutely.
So, and sometimes we can get you to push your employers to do things like this too. So just that's good conversations to have. Any comments more on maybe deductions of itemizing or tax credits?
The biggest thing I tell all of my clients, especially in my newer clients, is that I can't help you if I don't know about it. So when you're meeting with your CPA, ask the questions. Is this deductible? And if it's a swimming pool, probably not. But if you're if you're a swim instructor, maybe. So it's the more we or I know about your individual situation, the more I'm able to provide tailored advice to you to maybe reduce your tax burden. And if I don't know about it, I can't do anything with it.
Okay, that's fair. And one other piece that I do talk to clients about too, Jeremy, is also that some of this does tie in, particularly when they get into that 62-year-old and older level, is taking their Social Security. Obviously, that does
Mhm.
count as income, or a portion of it does. So we want to have a conversation about that too in retirement years, as far as what will be taxed and not taxed. This may be a little deeper, so just to kind of piggyback on this a smidge when I mentioned company retirement plans or even IRAs. Uh, it's when we talk about reducing taxable income, Jeremy, we're not just when we do it, we're looking at generational. So we're not just looking at the family, at least the couple we're talking to, particularly if they're older, because we're also talking about what that taxable income may be on their children later. So
Mhm.
that prime example, people listening, if you we have a lot of clients who are famous for, and they have pretty good salaries. They're more maybe white collar professional clients, and they defer a lot of money into their corporate plans, their
Mhm.
deferred accounts, 401ks, 403bs, things like that. Well, at some point that money may go to the kids, right? So we have that 10-year rule. So if their kids are beneficiaries, they have to distribute those funds out over 10 years, which is taxable to their children. So if they have a child who is an adult child who's in also, a doctor has a doctor as a son or a daughter, they're going to have a high taxable event too with those, inheriting that money. So we get deeper in a generational plan and would reduce the taxable income for their kids too. How can we restructure some things? Maybe it's Roth conversions, maybe it's estate planning smartness to make sure their kids also we can reduce potential taxable income for them later as well. If
And
that,
and that's where things get really interesting is how can we not just minimize our tax burden in the current year, but make a generational impact that helps your family grow well.
yeah,
And
yeah. So
too,
and that's when it gets fun.
yeah, exactly. And if if you hit your life expectancy, as we all hope to, your children are likely in their highest earning years when they inherit these IRAs.
Right.
So it's just like you said, it's a can be a tremendous tax burden to them.
So what we coach clients is it's not just about 2025, it's really thinking about much further out than that also as we do this.
That's right.
Okay, let's go to the next one. Any tax law changes that you're seeing on the horizon coming for 2025 before the year ends?
Just too many to count or try and name.
You mean there's actually conversations out there about doing things?
a little staggering as I try and last week especially tried to dive into the details and figure out what this means or might mean to my clients.
Right.
It is largely it looks like currently that most of the Tax Cuts and Jobs Act that was passed in 2017 will get extended and get a little bit better. Most of the income tax brackets are going to stay the same. The top tax rate will stay at 37%. The brackets will be indexed for inflation as they previously were. The standard deduction will remain at or increase to $30,000 for 2025 under the current legislation. So largely, things will look the same. There's a lot of added changes, specifically for the middle class on additional charitable deductions that you might be able to take if you take the standard deduction, increased, child and dependent credits. But it is a tremendous amount. And what's frustrating is it's still in the House. So who knows what the Senate will do with things once they get their hands on it.
So that's a question I was going to go back to you when you said, because like we talked about at the beginning of this is the time of year we do. And you mentioned too, like to really get down and start strategizing with clients. Well, if there's some things in that's sitting that hasn't passed yet, but potentially could, how do you really have that conversation with clients if you're meeting with them, say today?
It's pretty difficult. And when I'm meeting with clients about very specific situations, what we try and take the temperature of is, are things better under current law than they will be under the new law if passed? And what's also frustrating about that is most of these tax law changes will be retroactive to January 1st of this year. My approach generally is we got to plan for what the status is right now. We know what the tax law is for 2025 as of today, and we need to try and optimize things for that,
Okay.
while also taking into consideration any potential changes as much as we can.
Okay. And everybody keep that in mind too as you're talking to your CPAs over the next couple of months or whatnot. That Jeremy's advice is sound. I love that. It's what we know. We're advising, or he's advising on what we know today, with also the caveat there may be some things that can take effect later. Okay. So we're doing pretty good on time. Everybody, we'll keep this again to roughly about another 5-10 minutes, if you will. For those who own businesses, not everybody on this caller is going to listen to this recording later own a business, but for those who do own a business, what should they consider as far as structure?
So this is actually one of the more interesting and just fun things that I do, especially with newer clients or with clients that are experiencing significant change in their businesses, growth or downsizing, is there is often tremendous opportunity to, again, optimize the way the business is structured. Getting new clients in, looking at their situation. Do they run a sole proprietorship, and are they making enough money that it makes sense to incorporate and get taxed as an S corporation? These are things we look at for or try to for every client for every year to make sure we're minimizing those tax dollars. And often, what I have found with my new clients is that there are things happening in the business that maybe weren't communicated to a prior CPA, or if they were doing their own returns, they just didn't know about. And once again, information is power there. If I don't know you didn't establish a 401k plan in 2024 or five, then I'm not going to fill out the form to get you tax credits for establishing a small business 401k plan. It's things like that. There have to be open communication in these matters with your CPA and advisors. I
Okay.
can't stress that enough.
Good. Good. Is there anything that's maybe any from an S to a C type? Is there anything in tax law right now that's helping one more than the other?
That on a case by case basis, maybe. Right now, the best argument for a C corporation, for a small, closely held C corporation, would be what are you going to do with the money? Are you looking to reinvest it in the business to fuel growth? Are you trying to pay down debt that you have that you use to acquire the business? And if that's the case, a C corp makes more sense. The tax rates are lower than those of individuals. And with an LLC or an S corporation, though that income will just get passed through to the individual and be taxed at individual rates.
Right.
So if you're in a growth mindset like that, a C corporation might make a lot of sense. It's also a lot more divisible than the other entity types. So if you're, trying to get private equity funding or looking to sell out or bring on new partners, it can make a lot of sense.
Okay, good. Very, very good. And I know this can get really in depth as far as business structure too. We could do a whole session just on this. All right, we'll go to the next one. So question 4. Are there strategies to lower my tax burden in retirement? I'll let you go first because obviously I always have things like this.
Yeah, this is we lean heavily on our financial advisor partners here to let us know what's coming down the pipeline and to help them optimize. And often I find for my clients that have great advisors, they're coming to us and asking the questions of what would this strategy do, and we're not even having to pilot the strategies. But it's with your income and retirement. It's all about the timing of the cash. When do you need to receive it to live at the lifestyle level you're accustomed to? Can we use after tax dollars? Are there pre-tax dollars, Roth conversions, all of these things? And generally, people like Chris are leading the charge on those discussions.
Yeah, I mean, I say this all the time. If you're a client of mine or heard me talk before on this call, you've definitely heard it. My favorite retirement client or new client is when, or if I can get a current client into retirement years, they have buckets. They have different tax type buckets saved uh, for for those needs for income to supplement income to pay expenses. I always tell clients there is a way that you can take charge of your tax obligations. There
Hmm.
just is. I mean, people thinking they'll get to retirement and then they're worried about, how much whatever they pull out of accounts, what's that's going to be taxed and at what tax rate, because the government can change rates anytime they really want to, per se. And
Hmm.
different, we're going to have many presidents before I retire or through my retirement years. So things are just going to happen. What I love is buckets. I love when we can have someone has a good sized deferred bucket, they have a Roth bucket, they have an HSA bucket, as we mentioned earlier, they have obviously a taxable bucket. It's in different types of investments, including cash for emergencies and things like that. Because as retirees, we are now in control of where we pull money, when we pull money, and how we're taxed on that, right? So
Hmm.
that is, to me, that's huge. And you'll hear as a client in a lot of cases, particularly if you've saved up in deferred accounts, as I mentioned earlier, with kids, passing it on to kids. But if you have most of your house and your 401k are your two biggest holdings, I'm going to probably, or my firm's going to probably have a conversation in your deferred account, your 401k, potentially considering Roth conversions. We run a lot of analysis on filling tax tier buckets, which you've heard that before. Filling the tier if you're in a certain percentage tier, but you still have a lot of wiggle room before the next one. We talk a lot about we have some wiggle room to do some conversions and that to fill that tier. We want to get people into more of they haven't done Roth buckets before. We want to get them there. So we'll talk about paying some tax now and show the analysis of how that can benefit you on not paying it late, having to pay it later, particularly because you're going to have to with RMDs, at the ages that the government's going to require at some point, and then they're in control. You're not. So we just love being able to do that for people, help go through that analysis. The timing issue of doing it doesn't. It is basically on where you currently, that's when we work with the CPA, Jeremy. We figure out where they were in 2024. Is there anything that's going to adjust for that client in 2025? They're going to realize other income. They got raises, bonuses, things are going to,
Hmm.
other, capital events, the gains that they may report. We just want to try to know where they potentially are going to be in that to do the calculation of how much to convert. Is that fair? Does that make sense? I know
That
you've
that
talked
make
about that before.
that makes complete sense. And to go back to the tiers or the buckets, it's really the principle behind all of this is really diversification. If you have your money in different vehicles, we understand there will be tax law change just about every 4 years. But if your money is diversified in these different vehicles, you've got lower risk and more options with how you take your money in retirement.
That's right. That's completely right. And then and one other thing we talk about too, the tax burden. It's we this may go into the next question. We'll let this next question roll real quick and then we'll end it. But it's also rebalancing accounts,
Mhm.
just so that for investments, that they don't have a situation where there's a large cap gain exposure they're worried about. Because what that does for people, it just numbs them, Jeremy, where
Yeah.
they're scared to death to take the gain. Even though the gain's a preferred gain because it's long term, they still get nervous because it could be a huge tax, consequence to do that. So rebalancing, tax loss harvesting, things like that really play into lowering tax exposure and the stress of that into retirement years.
Hmm.
Okay. So last question we'll do today is how can I minimize taxes on my investments? Do my job for me. Tell me how we do
Well,
that.
I think you just answered it. And
Some of it, yeah.
the tax loss harvesting is one of the most crucial things, and rebalancing your portfolio regularly. So if you have these big capital gain events and these other equities where there are significant losses, offsetting the two makes a ton of sense. Rebalancing, resetting your basis in these equities. It makes it a lot easier to plan for when we know what the gain is and we minimize it. You know, otherwise, looking for preferred investment vehicles, bonds, municipal bonds, it just really depends on your risk. The less you pay in taxes on your investments, generally, the lower the rate of return.
Tends to be that way, doesn't it? So, and that's and so, the tax loss harvest, that's huge for us. And we don't look at it as far as a certain time of year to do that, Jeremy. It's just when opportunities allow. So
Mhm.
if we can, offset some gains with some losses, that's fantastic. The other thing too is that if we consider ourselves in a maybe, potentially more historically low tax environment anyway, there may be some gains without losses against them. We may have a conversation with clients. Let's just go ahead and take them now before we get trapped into you possibly could be trapped into a higher tax bracket, or the tax brackets in general change in 3 or 4 or 5 years. You know what I'm saying? So sometimes it's worth just to take the gains off the table. One, for protection, to go ahead and say, I've made that money on them. Let's put it in our pockets, as well as we are in a fairly low tax environment in general.
We are, and it's one thing you've skirted around but haven't straight up said. It's the peace of mind factor of knowing, I have taken the gain, I've paid my tax on it, and I know what I have left in my pocket.
Right.
And it's that peace of mind, depending on your risk profile and where you are in your career, it can be worth it to pay more in taxes for it.
Right. And you mentioned preferred investments again. That's, preferred dividends versus that get taxed at a different rate versus interest income, which tax at your income tax bracket. So that it's basically working with, it's a combination of, and I don't see this as us, it's always a combination of us, people like us, and our CPAs, or our client CPAs, to kind of go through this analysis, say here's who you are as an individual, as a
Mhm.
couple, as a family, and what do you need? It's not what do we think you need, is what do you need? Then we can give you some advice on what that possibly can be for returns and taxes. And just like we said at the very beginning with just income, if we can save people money, Jeremy, if we didn't make a lot of money on their investments. Now, I have a
Sure.
feeling that we would get fired pretty quickly if we didn't help people make money on their investments. So, we're going to do our best to minimize what we can, but we're also trying to maximize the returns, the risk with that for what people need their money to do for them. Is that fair?
That is fair. And again, it's just about optimizing all of these things.
Right.
There are hundreds of different levers that can be pulled, from your chair or from mine, that can change the situation. And working together, making sure your CPA and your financial advisor are working together on these things is also crucial, because
Right.
you can't make these decisions in a bubble.
So the key to this for us to do this for people listening is just to get you thinking a little bit and to ask you to have these conversations. You may get called by your CPA wanting to have a meeting to talk to your strategy. Take those meetings. I don't know, Jeremy, if that's ever a problem in your firm, but I've talked to clients who said, "Yeah, I just never got with my CPA last year, and I know he or she did call me." Don't ignore those. Take those meetings when your financial planners, if it's us or somewhere else, I'd love it to be us, but if someone else wanted to reach out and talk to you about tax strategy, It's not to it should be a very customized plan for you and your family, and we take that seriously, trying to do the best we possibly can. So for your professionals that you're working with, let us talk to you. We're trying to figure out ways that we can again maximize income returns, but also to lessen tax burden if possible, Jeremy.
That's right, and it works the other way too. If you know you have a big event coming up, let your CPA and financial advisor know.
Thank you.
It's I say it all the time, and I know it's corny, but if you call me before you buy or sell the thing, maybe I can give you advice. After you've done it, all we can do is account for it.
Yeah, that's great advice. I'm so happy you said that. So with that, we're going to end the meeting today. Jeremy and our contact information are right here. If you want to take a quick picture of that so you have our contact numbers and emails if you don't have that already. And you can reach out to us anytime with questions. And also this is recorded, so I will have this up on our YouTube page within the next few days if you want to rewatch something or share this with anybody else. But with that, Jeremy, thank you so much for your time today. I really appreciate it, and we'll talk to you soon, my friend.
Thanks, Chris. It's been great.
All right, buddy. Thank you.
Thanks. Bye.
Bye bye.